You know that feeling, right? That gut punch moment. You just hit submit on a trade, maybe a big one, and bam, this wave of did I just screw up hits you.
Or maybe it's looking at a stock you own that's just cratered and you get that cold, hard feeling knowing you bought high or sold low
Yeah,
again.
exactly. And it's so easy to blame, I don't know, the market, maybe bad luck, algos hunting my stops, what have you.
But let's be real here. Let's be unfiltered. That wasn't just bad luck most of the time. It was probably driven by a kind of mental tax, an internal thing that costs you way more than any broker fee.
The tax. How do you mean?
It's the cost of your own brain doing what it evolved to do, which is great for, dodging predators,
Mm.
but absolutely terrible for navigating modern finance. That's the cost of cognitive bias.
Okay, cognitive bias. So this deep dive then, it's not going to be about reassuring platitudes.
No, definitely not. This is meant to be a direct kind of no bullshit guide. We're exposing these psychological traps, these hidden ways the market, or rather your own mind, takes your money.
Right, we've pulled together a lot of material here, all focused on, let's say, battle-tested strategies and just the plain truth about how this stuff works.
And the mission really is to arm you, to give you actual defenses, to protect your capital, make smarter moves, and, well, stop being your own worst financial enemy, because often we are.
Okay, I think we're ready. Let's dive into the uncomfortable truth about our brains and our money.
So first step, let's really define this enemy, cognitive biases. Think of them like the market's pickpocket.
A pickpocket. Okay, I like that analogy.
Yeah, they're fast, they're quiet, they're really effective. They take your money, sometimes bit by bit, sometimes in one big hit, and you often don't even realize you've been robbed until much later.
And the damage is done by then. Then we spend all this mental energy trying to justify why we made that bad decision after the fact, right? Which just sets us up to do it again. We confuse the bad outcome with some external cause, not our own process.
Exactly. And what makes these biases so powerful, so insidious, is where they come from. They're deep-seated. They're mental shortcuts, heuristics, hardwired into our, what Daniel Kahneman called System 1 thinking.
System 1. That's a fast, intuitive, automatic stuff.
That's the one. It's what helped our ancestors survive. See a shadow move, run first, ask questions later. Speed over accuracy was key back then.
Makes sense for survival, but not for investing.
Absolutely not. Investing, especially long-term investing, needs that System 2 thinking. Slow, deliberate, analytical, rational. So that evolutionary advantage, quick emotional judgment becomes a total liability in the financial world. It just clouds everything when you need clarity the most.
And it hits everyone, doesn't it? It's not just for beginners.
Oh, completely. That's crucial. Biases don't discriminate. Seasoned pros, hedge fund managers, Wall Street veterans, they all fall for this stuff. Why? Because it's built in. Being human means having these flawed shortcuts wired in. Put money and pressure into the mix, and those shortcuts get really expensive.
So you have to actively fight your brain's default mode. You have to force System 2 online, which takes effort. And we naturally drift back to the easy way, the shortcut.
Precisely. It's exhausting to be constantly vigilant against yourself.
Okay, let's make this concrete. Let's talk about GameStop, 2021, that whole frenzy.
Oh, yeah. GameStop was almost a perfect storm of biases colliding. You had retail investors piling in, totally ignoring traditional metrics. I mean, nobody was looking at the actual fundamentals of a struggling games retailer.
Yeah, it wasn't about fundamentals at all. It was something else.
It was psychology. Primarily, you saw herd mentality just explode, mixed with massive overconfidence and a heavy dose of recency bias because the price had only gone up recently.
And platforms like Reddit, Wall Street Bets, they became echo chambers, right?
Totally. Social proof completely replaced due diligence. The question wasn't, is this stock fundamentally worth $50, $100, $300? It was driven by pure FOMO, fear of missing out. It became, if I don't buy right now, am I going to miss the rocket ship everyone else is on? It was about belonging to the group winning.
And the end result was, well, predictable, sadly.
Completely predictable. The stock hit insane levels, $483 a share at one point, then the bubble popped, as bubbles do. And the latecomers, the ones swept up purely in the emotional wave, they were left holding basically worthless positions, huge losses, life-changing for some.
So the raw truth here is, these biases aren't just academic concepts. They're a real constant tax on your returns.
Exactly. There's a literal financial bill that comes due when you let emotions and these mental shortcuts steer the ship, especially when things get choppy. Awareness, just knowing about this stuff isn't the whole solution, but it's the critical first step. You have to accept your brain isn't naturally wired for financial success. It's wired to betray you here.
Okay. Accepting that is sobering, but necessary, I guess. So once we accept that, we can start figuring out how to fight back. Let's name the biggest offenders, the ones that really screw up portfolios most often. All right, let's get specific. We need to name these things. What are let's call them the 3 most common, most expensive cognitive biases that just tank investor portfolios? These are the real villains.
Okay, villain number 1, confirmation bias.
Ah, yes. This is where you basically only look for stuff that proves you're right, isn't it?
Precisely. It's the tendency to actively seek out information that confirms what you already believe or the decision you've already made, while conveniently ignoring, downplaying, or just completely missing the red flags screaming at you.
Your brain builds a little protective shield around your idea.
It really does. It's why, after you buy that super speculative tech stock, you suddenly find yourself only clicking on articles calling it the next big thing and scrolling right past the ones talking about the shaky financials or the questionable CEO. You're hunting for validation, not truth.
And the internet makes this so much worse now, with algorithms feeding you exactly what you want to see. It's like confirmation bias on steroids.
It absolutely is. Your internal bias gets reinforced by an external algorithmic bias. It's tough to break through.
Okay, give us a real-world example of confirmation bias causing damage.
Well, a really stark one was Nikola Corporation back in 2020. Remember them? The hydrogen truck company, hailed as the next Tesla.
Vaguely, yeah. Big hype.
Huge hype. Investors desperately wanted to believe in this disruptive, clean energy story. They were so bought into the narrative that they selectively ignored some really sketchy details that were, frankly, hiding in plain sight.
Details like what?
Like reports questioning their technology, lack of actual working prototypes, videos that later turned out to be staged. But investors, caught in confirmation bias, just filtered that out. They focused only on the positive projections and the charismatic founder.
Until the truth came out.
Until the Hindenburg report came out with fraud allegations, the stock completely imploded. People lost fortunes because their research was just an exercise in confirming their own hopes, not critically assessing the reality.
Wow. Okay, that's confirmation bias. What's trap number 2?
Trap number 2, herd mentality. This one is incredibly powerful. It's the belief that if everyone else is doing something, it must be safe, it must be right, the crowd knows best. Right.
Wrong. History screams that the crowd is very often wrong, especially in finance. Following the herd seems like the direct path to pretty much every major financial bubble and crash we've ever seen.
Absolutely. It's irrationality amplified by social pressure. And it's timeless. You go back centuries. Tulip mania in the Netherlands in the 1600s, people were paying more for a tulip bulb than for a house.
Just insane.
Yeah.
Because everyone else was doing it.
Exactly. Fast forward to the dot-com bubble, the 2021 meme stock craze, the SEP boom, same dynamic. Everyone's getting rich. I gotta get in now before I miss out.
But the really scary example of herd mentality has to be the 2008 housing crisis, doesn't it?
Yeah.
Because it wasn't just individuals.
No, that's what made it systemic and catastrophic. You had major banks, rating agencies, regulators, sophisticated institutions, all caught up in the same delusion. Housing prices only go up. They followed each other into incredibly risky mortgage products based on groupthink, not sound risk assessment.
And when that herd finally went over the cliff,
Trillions in wealth just evaporated globally. Following the herd doesn't give you safety in numbers. It just means when the correction comes, you're right in the middle of the stampede. Maximum pain.
okay, painful lesson. What's the third horseman? Trap number 3.
Trap number 3, anchoring bias. This one is maybe the most common reason people hang on to losing stocks for way too long.
Anchoring, like a ship's anchor.
Exactly. Your brain latches onto the first piece of information it gets, usually the price you paid for an asset or maybe a recent high price, and it uses that number as a fixed reference point, an anchor, even if it's completely irrelevant to the current situation or future prospects.
So I bought a stock at $100, now it's $50.
Right. And let's say the company's fundamentals have deteriorated badly. New competition, bad management, whatever. Logic says, cut your losses, sell, reinvest that $50 somewhere better.
But the anchor.
The $100 anchor holds you mentally hostage. You think, oh, I'll just wait till it gets back to $100, then I'll sell, break even. That $100 is dragging your portfolio down. It's preventing you from making a better decision today.
This sounds like the disposition effect I've read about. Selling winners too soon, Holding losers too long?
Anchoring is a key driver of the disposition effect, absolutely. You sell winners quickly to lock in a gain relative to your anchor purchase price, which feels good, but you hold losers because selling below your anchor feels like admitting defeat, crystallizing the loss. It hurts more psychologically.
The dot-com bubble must have been full of this. People anchoring to those insane, unprofitable startup valuations.
Totally. Stocks like Pets.com. People were anchored to prices that had zero basis in reality. They refused to sell as the stocks plummeted because they couldn't emotionally stomach selling so far below their anchor price, even when the rational move was clearly to get out. They rode them all the way down to zero.
Prioritizing emotional comfort over financial survival.
That's a good way to put it.
Okay, but let's play devil's advocate for a second. What about the efficient market hypothesis, the EMH? The theory says prices reflect all available information, so maybe these biases are just noise. Doesn't the market sort of correct itself?
That's the classic counterargument, and EMH isn't entirely wrong in the very, very long run, maybe. But it assumes perfectly rational actors and instant information processing, which we know isn't true because of these very biases.
So EMH ignores the messy reality.
It largely ignores how irrational, biased behavior is the fuel for the bubbles and crashes in the short to medium term. That's where real people lose real money. Theory is nice, but reality bites. The market might find efficiency eventually, but if you've been wiped out by anchoring or herd mentality along the way, that theoretical efficiency doesn't help you much.
Right. Surviving the inefficiency is key. Okay, let's put something actionable out there right now. To fight confirmation bias, the suggestion is write down your investment thesis before you look at anything else. Then, and this is the hard part list, 3 solid reasons you could be totally wrong.
Yeah, forcing yourself to actively seek out the disconfirming evidence. It's like building an anti-confirmation bias muscle. It's uncomfortable, but necessary. Okay, let's really hammer home the cost. These biases aren't theoretical nuisances. They are actual wrecking balls demolishing portfolios in the real world.
Let's go back to the meme stock madness, GameStop, AMC, in 2021. We touched on herd mentality, but let's dig into that overconfidence loop.
Right. It wasn't just following the crowd. It was this powerful belief that this time the crowd was right and could actually bend market realities. GameStop became more than a stock. It was an identity, a movement. The logic morphed from investing to crusading.
We can beat the institutions to the moon, that kind of thing.
Exactly. And that collective narrative bred extreme overconfidence. People genuinely believed they couldn't lose because they were part of this powerful, unified group. It was classic groupthink, escalating risk-taking to irrational levels.
The pain wasn't just numbers on a screen when it crashed.
No, not at all. Someone who bought GME near $480, believing the hype, and then saw it crash below $100 in weeks. That's not just a financial loss, that's a huge emotional blow. It shakes your confidence, maybe makes you swear off markets entirely, or worse, fuels even more desperate revenge trading type decisions later.
The lesson being, intense popular excitement is almost always a danger signal, not a buy signal.
Almost always. Now let's look at the 2022 crypto crash. That was a masterclass in confirmation bias and maybe illusion of control.
How so? The whole space felt very trust me, bro, for a while there.
Well, the entire industry was pretty opaque, highly complex, leveraged to the hilt, and platforms like FTX. There were warning signs if you looked. But investors were so deeply invested emotionally and financially in the crypto is the future narrative.
They were only reading the good news, only seeking out the to-the-moon predictions.
Exactly. They were actively filtering out or dismissing the complex technical warnings about risk management, about leverage, about the stability of these centralized exchanges. They were, as the saying goes, only reading news that pumped their bags.
And when FTX collapsed, it took billions with it.
Billions vanished. And yes, there was fraud involved, clearly. But the scale of the loss was enabled by widespread confirmation bias. People put their life savings onto platforms with massive visible risks because they had filtered out any information that contradicted their belief in inevitable crypto riches.
The lesson there seems pretty stark. If your information diet only confirms your existing beliefs, you're basically building your own failure.
You're setting yourself up, no question. Okay, let's hit anchoring again with a slightly different angle.
Yeah.
Tesla's incredible run in 2020.
Right. The stock went up, what, 700% or something crazy?
Yeah.
Valuations went parabolic.
Insane run. Now, imagine you bought Tesla relatively early, maybe pre-split, at what later looked like a bargain price. That low price becomes your anchor.
Okay.
As the stock soared to levels that seemed, by any traditional metric, completely detached from reality, many of those early investors refused to sell or even trim their positions. Why?
Anchoring. But how does that work when the price is going up?
They were anchored to the idea of limitless potential suggested by the recent run-up. They saw the current high price not as risky, but as just another step on an inevitable climb. Selling felt like leaving money on the table, betraying the potential represented by that anchor, the narrative of infinite growth they bought into. It fed into the disposition effect reluctance to sell a winner.
So they held on too long, watching paper gains get huge, and then maybe evaporate in the corrections.
Precisely. Huge swings followed. Many saw massive paper wealth vanish because they were psychologically anchored to the peak or the dream, rather than rationally assessing the current risk-reward and taking profits. The feeling of holding a winner overrode the financial logic of rebalancing or securing gains.
The brutal lesson. Yesterday's price, whether high or low, tells you almost nothing about tomorrow's value. Focus on today's fundamentals, not nostalgia.
Exactly. Forget the anchor.
Now, we have to address the counterpoint again.
Yeah.
Some people did make fortunes timing these runs, right? Riding the momentum. They'd argue that gut feel and following the trend can work maybe better than rigid discipline sometimes.
Look, somebody always wins the lottery too. Does that make buying lottery tickets a sound financial strategy? Of course not. Yes, some people get incredibly lucky timing the peak of a bubble. They ride the wave of pure bias and euphoria and manage to jump off just before it crashes.
But for every one of those,
For every single lucky winner, there's a massive graveyard filled with investors who tried the exact same thing, relying on gut feel and momentum, and got absolutely crushed because their timing was off by a day or an hour. Discipline can be replicated and scaled. Luck can't. Relying on luck is just gambling.
okay, point taken. So let's make the defense against anchoring and that disposition effect really concrete. You mentioned a portfolio review.
Yes. It needs to be ruthless and regular, say, monthly. For every single stock or asset you hold, you have to ask yourself one question, and you have to be brutally honest. If I had the cash equivalent of this position right now, would I buy this specific asset at this current price today?
And if the answer is no?
If the answer is honestly no, then the only reason you're still holding it is emotional attachment to your anchor price or past performance. The anchor is holding you back. It's time to sell and redeploy that capital more productively, regardless of whether it's a gain or a loss relative to what you paid.
Okay, we've defined the biases, we've seen the damage they cause. Now, the crucial part, building the defenses. If emotions are the breeding ground, then discipline has to be the firewall, right?
Absolutely. These need to be practical, no-nonsense defenses designed specifically to override that flawed System 1 wiring when money is on the line.
Let's start with strategy number 1. The pre-mortem checklist. What is that?
It's a powerful technique to directly fight confirmation bias and that dangerous overconfidence we all have. The core idea is simple. Before you make an investment, you actively assume it's going to fail, catastrophically.
Assume failure. That sounds pessimistic.
It's strategically pessimistic. It forces your brain into System 2. Instead of just thinking about all the ways it could go right, you force yourself to imagine it going terribly wrong. It triggers what psychologists call the availability heuristic, making failure scenarios more mentally available or easy to recall, counteracting the usual bias towards recalling only successes.
So how do you actually do it?
You sit down and you meticulously write down every specific reason this investment could blow up in your face. And I don't mean vague stuff like market risk. I mean concrete things. A key patent could be invalidated, their main supplier could go bankrupt, the CEO has a history of exaggerating results, rising interest rates could make their debt load unmanageable.
You need a certain number of these.
The rule of thumb is, if you can't come up with at least 5 distinct, plausible, serious risks, you haven't thought hard enough. You're probably still wearing rose-tinted glasses.
And this checklist becomes part of your process for every single trade.
Every significant one, yes. You run the potential investment through this gauntlet. Ask yourself tough questions. What data that contradicts my thesis have I seen, and am I taking it seriously? Is my excitement based on the recent price jump recency bias or on solid long-term fundamentals? And maybe the killer question, if this thing drops 50% next week, what reason will I give myself then, and is that reason valid today?
Okay, that's intense. Strategy 2.
Strategy 2. Seek the contrarian voice. This requires something often in short supply, especially after a few wins. Intellectual humility. You need someone you trust, an external voice whose specific job is to be your devil's advocate.
Someone who won't just agree with you.
Exactly, someone who won't just drink your Kool-Aid, as they say.
Yeah.
Ideally, someone who isn't emotionally or financially invested in the same things you are. Their job is to challenge your assumptions, poke holes in your logic, and expose your blind spots without fear of offending you.
So if I'm super bullish on some speculative stock,
They should be the one asking, okay, but why isn't the valuation complete garbage? What makes you trust this management team? Couldn't competitor X crush them next year? They need to attack the thesis.
how do you formalize that?
Schedule it. Maybe once a month, have a red team session, bring your highest conviction ideas, lay out your case, and then let your designated contrarian just tear it apart. Logically, respectfully, but ruthlessly. If your thesis holds up under that kind of impartial fire, great. If it crumbles, they just saved you potentially a lot of money.
Find someone who will call you out. Got it. Strategy 3.
Strategy 3. Build a rules-based system. This tackles the emotional component head-on. Since biases thrive on emotion, you need a written discipline plan that acts like a pre-commitment. Your rational self needs to set the rules before the market's emotional chaos hits.
Like Ulysses tying himself to the mast.
Exactly like that.
Yeah.
You pre-commit your future emotional self to follow rules set by your current rational self. This means setting hard, non-negotiable rules for buying, holding, and especially selling.
Automatic rules.
Automatic and absolute. They have to override your gut feeling, especially when things get volatile. This is how you fight anchoring and the disposition effect. The rules make your entry price irrelevant to the sell decision.
Okay, give me some examples of rules for that one-page investment plan you mentioned.
Sure. Things like maximum position size. Never allocate more than, say, 10% of the portfolio to any single stock or high-risk asset. Or, critically, mandatory stop loss. If any individual holding drops 20% from my entry price, sell immediately. No negotiation, no waiting for a bounce.
Ouch, that's strict. What else?
Rules about maintenance are key too. Rebalance the entire portfolio back to target allocations every quarter. This forces you to trim winners that have become overweight purely due to price appreciation, fighting recency bias, and potentially add to losers that might be undervalued.
And the key is, write it down.
Write it down, print it out, tape it to your monitor, whatever it takes. It's your contract with yourself to stay rational.
Now, some people push back on this. They say rigid rules are like handcuffs, right? They kill the flexibility you need to grab opportunities in fast markets, kills the potential for alpha.
It's a valid concern. A system can feel restrictive, but here's the counter. Flexibility without discipline isn't sophisticated trading. It's just gambling with extra steps. A good system isn't meant to capture every single lightning-in-a-bottle opportunity. It's designed primarily to protect your capital during downturns and prevent catastrophic emotional mistakes like panic selling at the bottom or FOMO buying at the top. That's where most investors destroy their long-term returns. Preparation over impulse.
Okay. Discipline is defense. Are there tools that can help identify these biases in ourselves?
Yes, absolutely. Your own brain is terrible at spotting its own biases. That's the bias blind spot. So leverage external tools. There are online tests, some developed by organizations like the CFA Institute, designed to help you identify your specific susceptibility to certain biases.
Self-assessment tools. What else?
Rigorous journaling is incredibly powerful, but requires honesty. Track every trade, but more importantly, write down why you made it. What was your reasoning? What information did you rely on? What were you feeling? Then review that journal periodically. The patterns of your mistakes, your biases will become painfully obvious. Are you always chasing hot stocks? Always anchoring to losers? The data of your own behavior doesn't lie.
Use your own history against your future self.
Exactly. And finally, use technology as your unemotional partner. Portfolio tracking apps, Morningstar, Personal Capital, many others can objectively flag things your biased brain might miss. Like, hey, your tech sector allocation just hit 40%, are you sure about that? They spot trend chasing or concentration risk based on data, not feeling. #NAC outro. So let's bring this all together. The bottom line is this. Cognitive biases are real. They act like a hidden, unavoidable tax on your investing performance. But, and this is the crucial part, it's a tax you can actively work to minimize.
It's not inevitable. By consciously fighting back against confirmation bias, by resisting that powerful urge to follow the herd, by cutting loose those anchors to past prices, You genuinely can tilt the odds back in your favor.
And this isn't just about feeling smarter. It translates into actual measurable results. There's solid research, like that study from the University of California back in '98, showing that investors who understand and actively manage their behavioral biases tend to outperform those who don't.
By how much?
By potentially up to 1 to 2% per year. Now, that might not sound huge in 1 year.
But compounded over decades.
Compounded over a 20 or 30-year investing lifetime, that 1–2% difference is massive. It's easily the difference between a comfortable retirement and, well, just scraping by. That's the real so what. Mastering your own psychology has tangible, long-term financial consequences.
The market really doesn't care about your gut feelings, your hopes, or what you read on Reddit.
Not one bit. It rewards clarity, discipline, and rational decision-making under pressure.
So the message isn't just be aware, it's take action. Don't just listen to this and nod along. You need to actually do something, starting today.
Yeah, pick one strategy we talked about, just one. Maybe start with that pre-mortem checklist. Take your biggest holding, or the one you feel most emotional about, and force yourself to list 5 concrete reasons it could fail. See if your conviction survives that honest scrutiny.
It really comes down to a choice, doesn't it?
It does. Keep letting your evolutionary wiring betray your financial goals and pay that hidden bias tax year after year. Or take control, implement discipline, and start investing with the rigor your future self deserves. Your portfolio really can't afford for you to wait.